There's an absolutely massive elephant in the room, and we've finally got to address this thing. That's right, it's Tuesday's nasty red bar. The tone of the market definitely changed slightly as the breakdown was taking place, but honestly, some of the indications that we watch have held up surprisingly well, and I want to point your attention to that in today's episode of the Midweek Market Update. Of course, towards the end of the video, I've got 2 additional trade ideas to share with you, so stay tuned for that. Anything that we're associated with is linked down below in the description, and a quick thumbs up before we get started is a great way to support the channel. With all of that said, let's dive into our SPY daily time frame chart. What do we see here from a trend perspective? Overall, we're still tracking a downtrend with highs, lower highs, and a new set of lower highs was found on the Monday session. Most importantly as well, we never actually got a daily close in this overhead balance here or above 404.50. We closed slightly underneath on the Monday session. Now, what buyers wanted to see was, okay, reasonable that we get a pullback underneath that low, but buyers wanted to see a higher low formed on the daily time frame chart above 401. The previous level we had been tracking was $400.75. It's been adjusted slightly higher. 401's the new level, but there was no higher low that was put in. Obviously, on the Tuesday session, as Jerome Powell was testifying, we fall back down into this previous balance area and move towards the midpoint. So technically, the new pattern that we're evaluating is a look above and fail. So look above, fail back into the range, and if you've been watching the channel, you know that the target should technically be the bottom end of the range here for the equal lows at 393.50. Now, that is a cause for concern because 393.50 represents what? Well, if you watch the Sunday video, represents the weekly higher low. So if the bulls are going to remain in control on the higher time frame, like the weekly time frame, can't really afford to get back down to the 393.50 area, especially as we remain in a daily downtrend. We would expect equal lows to break for trend continuation. So that's the risk here. That's the threat from the bears at this point in time. But let's also acknowledge that on today's session, we did print a hammer candle off the midpoint of this range. We technically closed above the 50 SMA, the blue moving average, and we've also respected the lower edge of the weekly expected move. Now, don't get me wrong. I'm not pounding the table. I'm not saying bulls on parade. I'm not saying we're going back up to 416.75. I'm just saying, hey, we actually broke down underneath Tuesday's low today, didn't get follow through from the sellers, and closed with a hammer candle. Could we see a pop for a lower high again and a reattempt of 401 tomorrow? Certainly strikes me as a reasonable possibility. Before we move on down to the hourly time frame chart, I want to also reinforce the idea with our Fibonacci's from low up to high that we're smack in the midpoint of this overall breakout range. We're at the 50% retracement. That's exactly where we've closed on today's session. So instead of saying bulls have an edge, bears have an edge, nobody really has the edge when you're smack in the midpoint of any given range. And especially if you add on top of that we're in the midpoint of this range roughly as well, once again, your edge really exists as we're breaking the top of the balance or the bottom of the balance, or we're getting mean reversion or mean reversion. So time will tell. I think the levels to be patient for into the end of the week at least will be 401, seeing what the reaction is there, or breaking down through here to get the equal low at 393.50. Right? The other thing we can point out is if we take out our anchored VWAPs, and these are all coming from the bottoms and most important inflection points from the October low here. So by bottoms, I meant this was the bottom, right? That's the most important inflection point here. You get a low here, that's the orange one, and here's the blue one, right? As we were discussing as of Friday's close last week in the Sunday weekly watch list episode, we were trading up towards the top of our VWAP bands here. You could think of this as an overall VWAP range, so to speak, and now we're just in the midpoint. So once again, does anyone really have an edge in here? Not entirely, I would say, from this particular perspective. Let's go back on with our 50 and 200 SMAs, and we'll move on down to the hourly time frame chart, where I think things also get a little bit clear from a psychology perspective, right? So here's that range. There's the look above and fail. Technically, we should go to the bottom end of the range, and that would just put us what? With equal lows on the hourly time frame chart, we're looking for equal low breakdowns underneath 393.50, which does a whole world of damage on the weekly time frame chart that we were just discussing. Now, the interesting nuance here that bears have to be concerned with, to be quite frank with you, is if we were to poke back above 401, this all of a sudden starts to look like an hourly higher low and starts to become the possible, again, possible, it's not guaranteed, but possible trend reversal on the hourly time frame chart. It would require an equal high up here, but it's a good first start, right? So what do bears want to see? Once again, lower high under 401, break down through here on the hourly time frame chart, there's your daily equal lows. We threaten the weekly trend, right? That's what the bears want to see at this point in time, or just blatant flush into the remainder of this week. What the bulls want to see is quite clear. It's the higher low over 401, price acceptance back outside of this balance, and a reattempt at the equal high here, much closer to 407. All right, so that's what I'm seeing on the daily and hourly time frame charts. Let's look at supporting evidence now. Supporting evidence, Exhibit A, as always, market internals. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. Very, very simple comparisons to make here on today's session. Compare the damage that has been done in this week's worth of trade versus the outflows from the sell-off period prior and the outflows from the sell-off period prior. By period prior, I'm referring to this selling period right here in the market. Obviously, there's much more momentum. There's much more force behind the selling that we've seen over the past 2 trading days, as exemplified from the cumulative volume build. In terms of the advanced decline line, notice that we're spending more time underneath zero here as the sell-off has been taking place versus back here, more time above the zero line as the sell-off was taking place here. Once again, speaks to more strength in the selling. And the most obvious of them all is the cumulative tick. If you take a look at the compression in the net builds on the day and compare that to what's taken place over the past 2 trading days, although yes, on today's session, things let up ever so slightly, I would just say, hey, we're getting bearish consolidation, bearish acceptance at these lows. It's definitely more meaningful than all of the selling that we saw throughout this period of history here in the past 2 or 3 or so trading weeks. So overall, there is a change in tone, as we've acknowledged earlier on. So once again, it might be more likely that on the SPY, we get that lower high underneath 401, flush for the equal lows 393.50, and then reassess from there. We'll be willing to adapt if these internals change, but as of right now, they would support more downside in the coming weeks worth of trade. Exhibit B is the market profile, and if you don't know what this screen is, video tutorial in the top right-hand corner for you. Overall, we want to assess our balance area. So here is the balance, and what we should do is just roughly divide that balance in half and point out where the points of control were. So above, below, right on or slightly below the midpoint, underneath, and of course this is the breakout day here, so we don't count that towards our balance count. But overall, a majority of the acceptance, a majority of the value as this balance was building out was in the lower 50%. And this would support the thesis that if the market is going to the highest area of liquidity, where the most transactions took place, quote unquote fair value, so to speak, it would align with exactly what we said on the SPY daily, which is 393.50 as a potential target, the bottom end of the overall range. So that sort of makes sense from a value perspective. And as we've broken down here, although the point of control was higher on the Monday session, it's really important to look at what took place on the Tuesday session, the catalyst day, as the breakdown was taking place. If we analyze Tuesday specifically, value obviously was lower, and the point of control did definitively move lower with price as well, confirming more of the bearish nature of that particular day. Now on today's session, we do get value that is overlapping to slightly lower, and I will say from a bull perspective, we do have a slightly higher point of control, but once again, the point of control is still inside of the value area from the Tuesday session. There's a poor high here, so I would really use today's high as a potential trigger to attempt that 401 level on your SPY. Why is 401 still important? Well, let's go ahead and do something like this. And we can see 401, roughly the equivalent of that here on our ES futures is around 40.20. And why is this level important? Because it's mechanical. We have a prior point of control. This was a VPOC. And as we recall from the Sunday video, ideally, we would have done something like this if the bulls were going to remain on parade and send prices in the upward direction, continuing the trend. But we went through the point of control, and now it's also the value area high from the Tuesday session. So confluence around 40.20. Once again, with the poor high from today's session, if we repair that poor high, we're looking to see what the reaction is from the market off of 40.20. Based on the internals, it would suggest that, hey, if the sellers are going to keep this momentum, we should expect a lower high to reject this mechanical level, and then possibly look for the bottom end of the balance, which we just saw is where there's fair value from a market profile perspective. So once again, 40.20 key inflection point on the upside. If we put in a lower high underneath it, I do think that the market could head back towards the bottom end of the balance. If we start to get above this area in here, we will have to reassess and say, okay, Are the market internals suggesting bullish momentum returning? Are we getting higher lows above? Is value shifting above, right? We don't have that as of right now, but once again, building the case that 4020 is your ES inflection point, 401 on your SPY daily time frame. So getting back on over to Thinkorswim to evaluate the weekly performance of our sectors, this is honestly where there's a slight bit of resiliency out of the market. The main thing I want to point to your attention is that the XLK, the tech sector, the heaviest weighted risk on component of our market, is actually outperforming the S&P this week, only coming in down 0.59%, whereas the S&P on a weekly basis is down much closer to 1.5%. Now, don't get me wrong, it's not the greatest thing to see staples and utilities above the XLK here, but nonetheless, the fact that the market's really falling apart here on the assumption that we're getting a 50 basis point rate hike in March, it's quite encouraging to see the XLK hold up towards the top of the list. It's a contrarian data point that would suggest, hey, maybe something like this can take place if, big emphasis on the word if, the XLK can hold up into the end of the week. Now, the concern is obviously that the XLF financials are getting absolutely obliterated, down roughly 3%, and they're the third heaviest weighted component of the S&P 500, so it will be fairly difficult to move in the upward direction if we're continuing to see massive pain in financials. Let's check in on the structural charts, though, and just see what's going on from a trend perspective. Here's the consumer staples. Remember that this is D for defensive. We don't want it outperforming. It's not threatening a break over 74. I would say it's suggesting that it might want to just continue to play nicely in this overall range. We had look below and fail. We had look below and fail. Notice that on today's session, we closed back inside or above, I should say, that 72 level. So just playing nicely here strikes me as A-OK for consumer staples. Next up is utilities. Again, D for defensive here. Really not getting any acceptance towards these lows. We're not breaking down underneath the low of the Tuesday session, kind of hanging out nicely in between 67 and 65. Once again, this does not strike me as the end of the world for the S&P 500. Overall, the trend here is definitively lower, no doubt about that. But remembering it's D for defensive, that's actually okay at this point in time. Next up, we'll take a look at the tech sector. This is where we're seeing that resiliency. So again, think about this as your balance. The SPY itself is in this balance area. The XLK is obviously above. It's remaining in the overhead balance from here, offering up the potential for some sort of like higher low pattern like this, holding that area of support. So once again, this is the one promising data point that I can see from a bull perspective that would suggest, hey, maybe just like dial it back one notch, just one notch on the bear thesis, and just expecting that we're rotating to the bottom of the overall range. So watching very, very closely 139.25 in the XLK. Next up is industrials. Once again, this does not look bad by any stretch of the imagination. You kind of have your ascending triangle still in place. I will say there was a failure to break out on the Monday session as we moved above the highs from right around in here. It's not the most promising look, but once again, we're not threatening big new lows. As long as we're above $100.50, good to go there. XLC communications, once again, from a weekly perspective, higher low can be found like this. Want to just see continued price acceptance really inside of this 4-day balance that's been established here. We want to get back above 54.30 for more meaningful things to take place, possibly inverted head and shoulders, right? If we start playing around down here, not the most promising look, definitely more of an H pattern when and if we breach 52. That's where I get concerned on the downside, more of a bearish force for the market. Next up is real estate, playing nicely in the overall range here. Not too many comments to make, noting it's a lightweight sector, not going to have too much pull for your S&P. Here's the XLE energy sector, D for defensive. So once again, we don't want it outperforming. It certainly isn't by any stretch of the imagination. It's playing nicely in this little box that we talked about in the weekly watchlist update from Sunday. Perfect. No complaints from energy here. XLV, definitely cause for concern. Second heaviest weighted sector by market cap. We know it's slightly more D for defensive from a posturing standpoint, but it does technically need to participate in upside rallies if the market move is going to be sustainable. Otherwise, it's just too much downward pressure or drag really to assist in the market moving higher, we'll say. So we are coming towards the bottom point of the monthly range here. 125 is the level. We had multiple fake breaks that we had talked about during these time periods, really watching to see what that reaction is. This chart in front of us would not give me a warm and fuzzy feeling. I mean, this is totally H pattern. It's totally lower high. It's accelerating the downward trend. This was very mild. Think about like lazy river. This is like Grand Rapids whitewater rafting, right? So really not a promising look out of the XLV. This definitely stacks up as more of a bearish data point. But once again, as we come into this 125 area of demand, I would just be mindful that dead cat bounce can happen, but lower highs, that's where we get back in the bear camp, right? So be mindful that new money shorts here, probably not new money shorts, but it's not promising for upside is what we're getting at primarily in the healthcare sector. Second heaviest weight worth spending some time on. Some concerns here as well in the XLY, unable to get above 148, so still remaining in this prior balance area here with technically a lower high underneath. H pattern, equal lows have been produced. Now we did form a daily hammer candle on today's session, but if we come back in for a reattempt of the lows, just any interaction further with 141.75, I would look for lower back to the bottom of this overall balance, remembering that the XLY is definitely more of a risk-on sector. That is a concern moving back down towards 135. So the fact that this did not get here, once again, more of a bearish data point. The only positive thing that we're seeing so far is the rough outperformance from the XLK. Not consumer anything. This is materials. Back in the midpoint of this overall range, nothing to say about this one. Lightweight sector, not going to have a whole lot of pull for your markets. And the XLF, lower high, confirmed underneath 36 with the new lower lows being made on today's session. Cause for concern, right? Very obvious here that the threat is a head and shoulders pattern, flush 34.50, and you kiss it goodbye into 33.15. That's why, once again, financials will really be the name to watch here, the sector to watch if the market's going to continue to pull lower, and if the market's going to rally here, XLK is where you want to keep your eyes. Here's the sector ratio grid. If you don't know how to set this one up, video tutorial in the top right-hand corner. This is just a different way to visualize relative strength to the S&P 500. Overall, the top four are the risk-on sectors. Notice once again that the XLK is outperforming here. This does strike me as the sole bull data point. XLF breakdown here is aggressive. Notice the acceleration, the steepness of that trend there versus really just the sideways malaise that we had been on prior. This is a cause for concern. Same thing can be said about healthcare. We just saw that on the structural chart as well. No longer really holding that double bottom area, certainly not above the neckline of the pattern, cause for concern. And this is okay, just kind of mild here in the XLY. Once again, 148 really wants to be recaptured in the upward direction. If this is going to perk up, kind of want to see support be held here at an upward sloping 50 SMA. That's the gold line on these charts. If we look at the bottom four, these are the risk off sectors, XLP, UE, and real estate, right? Overall, risk off is not really coming back. It's not bouncing back in an aggressive fashion just yet. I will concede that it's off of the lows here, but it's underneath a descending 50 SMA. It's off of the lows, but underneath a descending 50 SMA. Energy, is actually curling lower, and real estate is hardly perking up off of the lows. So once again, it's not that risk off has dramatically returned to the market. It's the pain in financials. It's the pain in healthcare. And ironically enough, the fact that tech is outperforming, I don't know that the bears are just, easily going to run away with this thing in the downward direction. I will concede that momentum is there. We saw that in the internals. We know that value is lower towards the bottom of the daily balance from the profile, but on a relative basis from a leadership perspective, the fact that tech is still outperforming does strike me as a positive look. Let's take a brief glance at what's going on from the XLY growth versus XLP value perspective. Once again, this is not breaking down aggressively. Now it could underneath these lows here, but we're coming right into support. Upward sloping 50 SMA, prior lows, and the rejection that was the nail in the coffin for this final leg lower right here. Notice, again, if you think about the slope of the line, go back to algebra class, right? Rise over run. Very, very mild move in here. Certainly not as steep as what we saw here. Certainly not as steep as what we saw here. So until proven otherwise, this is just healthy digestion of this overall trend reversal. We're still watching for healthy outcomes in the future. We just haven't perked back up. We have not broken out of this flag pattern yet. It could also deteriorate, but once again, the slope of this pullback is not aggressive as of right now. If we move along and have a look at our dollar, this is certainly a cause for concern, noting that our inverted head and shoulders is definitely playing out. We did make a higher high above 105 here, so trend reversal back in the upward direction is well underway. If I just zoom in on this segment of the chart, we've got lows, higher lows, higher lows, highs, higher highs, and higher highs, even above this prior pivot high. As this moves higher, of course, that would suggest downward pressure in our equities market. A cause for concern here as well is taking a look at the gold contract and noting that we did not hold by any stretch of the imagination this little bounce that we had started, and obviously the big reversal on Tuesday brought us right back down to the equal low. So now you're looking at an H pattern and a flush here to get to these lows, which on the dollar is kind of already where we're trading at, right? On a relative basis, it would suggest that the dollar could potentially make a much higher high, which of course has bearish implications for equities. So overall, the combination of dollar and gold right now is not all that positive for equities moving higher and supports more of the bear thesis. If we take a look at the TNX 10-year interest rate as well, what you'll notice here, if we zoom zoom in is, of course, there's your double bottom. We talked about, hey, this is great. We had a little island reversal, but we're still above the neckline of this particular pattern. And as long as we're above 38.8 in the TNX, which is 3.88 in the 10-year yield, we're really not making any substantial progress in the downward direction, which is going to be really harsh on tech. Now, ironically, tech is outperforming, but you get the idea that as long as this is above, should be, not the best for equities to start to reverse and move in the upward direction. It should put downward pressure on equities here. Even if we break down underneath 3.88, there's still a strong opportunity that we remain in an uptrend, finding a daily high or low anywhere in between this range above 34.3. So overall, I'm seeing some bearish implications from the dollar, gold, and rates when you look at them in a holistic picture. Now here we have perhaps my favorite chart of the night, the Fed tracker tool. Not only is this thing beautifully symmetrical, but this represents perhaps the fastest change in expectations I personally have ever seen out of the market. If you recall from Sunday's video, we were hanging out around here looking at about, I don't know, what was it, 65, 70-ish% likelihood of a 25 basis point rate hike in column number 1 over here. And as of today's close, there's about an 80% likelihood in column number 2 that we get the rug pull 50 basis point rate hike that nobody was expecting as of only a few days ago. So very, very fast change in what the market's expectations were, and obviously that's why the market had such an aggressive day lower on the Tuesday session. Now, there's all sorts of nitpicky things we could say about the testimony and the political theater, so to speak, that was taking place there, but Jerome Powell did make it clear in his testimony that, hey, we're going to follow the data. The data did actually get revised to being a little bit hotter than the expectations. If the jobs numbers continue to come in strong, the market can withstand a 50 basis point rate hike, then hey, we might have to do it, all right? We also learned, I'm going to insert the clip right after I'm done saying this, Jerome Powell is committed to following the law. What an absolutely ridiculous question. I mean, you can't make this stuff up, right? So I'm going to roll the clip, but unreal.
To that end, will you commit that any ongoing capital review by the Federal Reserve will follow the law, and that any follow-on regulatory proposals will be risk-based and tailored to an institution's activity, size, and complexity, and not a one-size-fits-all?
Yes, I can easily commit to that. We're very strongly committed to tailoring, and that'll be, I can say that anything we do will reflect tailoring, which is a long-held principle for us and also now a requirement in the law.
Yes, sir. Thank you very much.
So now that you've had yourself a good laugh, let's get back to business and take a look at the risk appetite of the market through the lens of the TLT first. We are underneath this congestion zone from back here, but it's really important to take a nuanced approach here and point out that as the market was selling off on Tuesday, there actually was a flight to safety and bonds outperformed on that particular day. So this is worth keeping an eye on to see if it turns into potentially more of that as and if the market continues to break down in the lower direction, possibly revisiting the lows of the balance that we've been discussing in today's video. This is a small cause for concern. We will continue to monitor it. Let's take a look at the HYG and see what's going on from this perspective. There's a big cause for concern here. We talked about the bearish divergence with the equal high out of the HYG, whereas the equities market was putting in a higher high, and this was saying, hey, come back down to earth. Now the threat, of course, just like it was before, is a breakdown of this should bring us to our next area of support. Just like a breakdown of this should bring us to our next equivalent area of support. Oh no, what does that mean for markets? 3,800. Okay, so I'm not suggesting that we go there this week, but once again, from a risk on, risk off perspective, risk appetite perspective, if the HYG starts to break down, and I get it, if we move here, it's probably not going to correlate to the full deal in equities all the way down to 3,800, but the risk in general is that a negative divergence playing out in the HYG would be cause for concern in equities. The HYG has been right the last 3 divergences that have played out. Let's see if it's going to be right for a 4th time. The last thing, this probably falls the lowest on the list of your overall analysis data points, is Bitcoin. Just bringing up that, hey, amidst all of this chaos, we are still above on the Bitcoin daily, weekly time frame chart, we're still above the breakdown candle high. So again, this falls all the way at the very, very bottom of your analysis list, but Bitcoin's holding up above 21.5K. If it continues to hold up, then who knows? Maybe it has slightly more neutral implications for markets. If it starts to flush, obviously it's back on the bear side over there in the crypto landscape. A few more red flags from our breadth indications. The first one is new highs versus lows sitting right back down on the 0 mark here, which is a cause for concern. The issue is that we can now potentially morph into a look once again like what we saw in 2022, which of course had bearish outcomes for equities. Now, the contrarians and the positive thinkers, the optimistic people out there would be saying, hey, can't we find support off of the 0 zero line and rotate higher to form more of a look like 2021. And while that may be a possibility, I would say we don't really look at this as a technical chart, number one. And number two, the fact that we didn't get follow through over these highs, this did act as resistance. Once again, this is not a technical chart, but the implication of not making a new high in this relationship would indicate that there's a big lack of follow through in the S&P companies or the New York Stock Exchange companies, right? A couple of companies made new highs, and that was really it. It wasn't really followed up by a continuation of new highs across the entire exchange. It kind of fizzled out after a couple of select few possibly made those highs. So that's what this is telling us. Once again, a red flag sitting on the zero mark. We'll learn something when we definitively get a stronger push one way or another away from that area. Let's take a look now at stocks above their 200 SMA in the S&P 500 specifically. Coming into the 50% mark in here, it's not a cause for concern until we really start spending some time underneath it. Recall that in 2022, almost all year, we were underneath that halfway point. So as long as we're above, I'm willing to call it neutral at this point in time. Ideally, we'd like it to be moving higher, right? But more concerning is, of course, stocks above their 50 SMA finding a rejection on the back test of the 50% mark. So once again, this is not a technical chart. We don't look at this as support and resistance, but what this would imply is that on this most recent leg up here in the markets, as we got that impulsive breakout, not, a lack of majority, less than half of the companies in the S&P 500 were able to recapture their 50 SMA, which is what this lower high is essentially telling us. Once again, does not really strike me as the most bullish data point for our markets. Let's have a look at the RSP equal weight S&P 500 now, and the concern here is that in the equal weight, we're actually already at the bottom of the balance, right? Notice how we just took an indecisive doji, a 3-bar play technically setting up at the bottom end of the balance. If this starts to break down early, could it drag the the regular weighted market lower as well? Absolutely could be the case. So watching to see if this starts to break down aggressively underneath roughly 146 would be your level in the RSP. That would be a bearish implication for the equities market S&P. Let's follow this up with the Dow and just point out that, hey, we've got ourselves an H pattern on the industrials, but we're still hanging out towards the top of this range in the transport. So this would say conflicting trends, conflicting. This is not confirming anything as of right now. You really want to see these things moving in sync, making a new pivot low and making a new pivot low. Obviously not the case as of right now, telling us to keep potentially an open mind about really more volatility as this market kind of gets torn apart. It's very, very focused on fundamental data at this point in time, right? We know that we'll be getting the jobs report on Friday, CPI next week, PPI next week, retail sales, inflation expectations, right? This is kind of in line with, hey, things are not in sync right now. Things are not playing nicely. And in a data-driven market, expect more volatility. That's basically what the breadth indications are telling us right now. Slight bearish edge to them, and Dow theory, hey, really, really out of whack right now. Now, at first glance, everything seems fine from a volatility perspective, with the VIX closing well underneath 2050 on today's session. And even as the market was breaking down here, it didn't make a run for it. It never saw a parabolic move up and over that level, indicating some level of comfort for the equities market. If we take a look at the VVIX itself, which is the volatility of the volatility index, it's completely breaking down, or threatening the break, I should say, underneath 75, the bottom end of this balance in here. From a volatility futures perspective, taking a look at this chart, we're continuing to move into a strong contango, trending lower underneath the zero line. Now, I said at first glance everything seems fine, and that's because I would expect things to go quite haywire as we approach the jobs report on Friday, CPI next week, all of the stuff we just rattled off on the Dow theory chart. As we get those events coming out, I would expect volatility to perk right back up. As a matter of fact, I think the VVIX, if anything, is telling us to be well aware of the complacency effect instead of just a massive breakdown in volatility, saying, hey, the slightest little discrepancy could do something like this and make your VIX get back above 2050, which would then indicate a lack of comfort for the equities market. So I would start to become a contrarian as we're sitting on these lower levels in the VVIX specifically. Finishing up the broad market with the QQQ and then IWM, notice that we've closed right on the upper edge of the lower balance and right on the lower edge of the upper balance. So 297.75 is the level. What I would point out here is, just like the XLK, there is a stronger opportunity for a daily higher low to be found. Now, once again, considering the weight of the evidence that we've walked through in today's video, I think there's a case to be made for downside, but just between the QQQ and the SPY, I'm pointing out that this is where there's strength. If you're looking for longs, it probably probably makes sense to be in the QQQ, trying to get the equal high up here closer to 302.75 on a hold, so to speak, of this daily hammer candle. If there, that requires a break above tomorrow at least, or maybe Friday, above 297.75. If tomorrow we start breaking down underneath the two equal lows, that's going to be at 296. That's where, okay, you start to say, great, we just have ourselves, like the S&P, a look above and fail, target the bottom end of the range. That would be at 289.75. Expect some sort of bounce when and if we get there. Just noting that we have the daily 200 SMA, 50 SMA will meet us there as well, and prior support was once resistance, just a technically respected level at 289.75, so be mindful of that. Once again, key levels for breaks tomorrow, 297.75 high and underneath 296 in the QQQ will be your deciding factors. IWM Russell 2000 and the small caps did see a look above and fail complete, did make the move all the way to the bottom end of the range, so knowing that we have a 100% retracement, maybe there's the opportunity for a bounce considering, right? So let's just draw this in as a range, right? We've got our buyers who failed at the highs, but we also have the sellers who failed a little bit less obvious here on today's session in that lower wick and also violating the daily 50 SMA, closing back inside of the overall balance. So does it turn into another look below and fail, target the top end of the range? I'm not convinced that that's going to be the case. Maybe it will be, but overall, I'd be much more neutral in the IWM as opposed to outright bearish, thinking that we flushed the lows. So once again, 100% retracement, failure from the sellers in this lower wick, thinking neutral through this congestion zone that we've been stuck in the past little while. Maybe on Friday when the jobs report comes out, that'll be the catalyst to sort of take us out of this range. If we're above 189.75, obviously that's the bull case. You look for the retest of the equal highs here, closer to 191.75, and underneath the lows here, this is a minor level at 183.82. I'm actually going to remove that. It's not really in play. Flushing these lows, you get a balanced double, which brings us into the strong weekly support at 181.10. Apple is up first for the core list of companies. Looking at an inside bar on today's session, very simple trade to watch for, either over 154 to target 156.50 or underneath 151 to target the daily 200 SMA and the low of the green breakout candle at 147.25. Very simple. Don't make it more complicated than it needs to be. Netflix, on the other hand, is a bit more complicated. Overall weekly, monthly, daily uptrend intact here. But if we zoom in, right, notice that this little down leg didn't really result in much follow through underneath that 311 that we were talking about flushing in the prior day's session. So the fact that we didn't really make it to 298, I'm not convinced that it's a long just yet, but maybe it turns into a possible failure from the sellers like this into the future. I think Netflix is a patience play and seeing if we can really resolve 315.50 with a higher low first. Next up is Tesla. This one's finally starting to break down a key range. This was just like dreadful price action back and forth. Never really wanted to break out over 213. Finally got a close underneath this 188.50 bottom end of the balance from in here. So we are watching for some bearish outcomes in Tesla as long as you remain underneath that level, 188.50. If we do get a retest of it, looking to position for shorts with overhead supply, weighing down on the stock, pushing prices in the lower direction. Over time, the target would be this gap close. I don't think it's in play into the end of this week, but that's kind of what's on tap for Tesla as we move forward. If we get a higher low back above, we're just back in chop zone. Take it as it's day by day, intraday trades only. Can't really recommend stronger longs until we're above that 213 top of range. Next up is Google. This is a short, and the reason it's a short is because we still have our head and shoulders in play. There's your neckline, multiple failures to get above the neckline at 94.25. Daily inverted hammer after failing to take out and stay above the prior day's high. Flush of the three equal lows, and your trade is back down into this zone. First target is the high of the break candle at 92, and then the low of the break candle at 90. That's what I would be watching for here. If for some reason it takes out the top of the range, not really interested in trading it in the upward direction here, noting the strength of this and just overall how that head and shoulders pattern is still kind of in play, right? This to me is much more indicative of a short setup. Next up, Metaverse. What's going on with Zucchiniberg's fantasy land here? Certainly back in the 2-day range, trying to find a higher low. Like the case to be made here is that we had like micro inverted head and shoulders. Now is it going to turn into like larger inverted head and shoulders? Maybe. I think that there's a case to be made that this failure from the sellers to really push prices back down into the bottom of the range here could be construed as a long back up towards these two equal highs at 188.75 into the end of the week if we take out today's high, and then from there obviously monitoring for continuation into the prior highs here. Wouldn't really be a short on this one till we get more price action back down underneath the green bars low and open here. It'd be underneath 180 roughly. If we start to get underneath there, fine. Doors open back up for sellers. Next up is NVIDIA. Strong strong. This is not a place to be short. It's very clear, right? As we started to move into the earnings gap here, and there's just a blatant rejection as we got the pullback in the market that was devastating and took back a majority of that 2-day rally. It just didn't happen in NVIDIA. And on today's session, we've closed above the high, above the breakout point here. So watching for strength to continue in the upward direction. Technically breaking and doubling this range does not bring us all the way to the gap overhead. It's just 250. 250 would be the upside target on some continuation over time, 250, 250, and then 258.25. That's probably confusing to hear through headphones or audio or whatever, but that's the gap range overhead to be looking at as we continue in the upward direction. For shorts, once again, I'll reiterate this, I'll stand by this. Probably not interested in shorts whatsoever until we start playing into this gap where there's basically no structure. This chart's just too strong to really be looking for short outcomes in NVIDIA. Next up is Softy. This one is back down in the confusing no man's land. So if this is turning into an inverted head and shoulders, it's got to prove it with more acceptance over 255.75. We don't have that as of today's close. We have a lack of acceptance on the Monday session here inside of this overhead range. We're just caught in between, right? So this chart is very ugly to me. I don't necessarily think that there's anything obvious to do in Microsoft. You could say daily hammer, long over the top, something like that, maybe, but it's just not clear to me in Microsoft. Next up is Amazon. And Amazon, as we've been saying, is very similar to Google, with your head and shoulders continuing to pan out. This one has a cleaner lower high. It never really made the attempt to get above that 96.50. Daily hammer candles, yes, but overall looking for this range to really break down and move us closer to 90.10. And then, of course, this is the ultimate target, closer to 87. That would be more ideal on some sort of follow-through flush. If it does start to take out the highs of this little balance, it's formed at 94.70, so be it. But once again, longs are really only tradable on higher lows above 96.50. This set of interesting interactions. Support, then turn to resistance, not really confident in longs until we're above based on the overall pattern. It's your lucky day. I just looked at my notes and I actually have 3 trade ideas for you, not just 2. First one is on Roblox, ticker RBLX. And of course, we're looking at this as a 3-day balance, not so much a daily bull flag. You could maybe call it an hourly bull flag, but 3-day balance in play here on Roblox. The long is over the top at 42 to get back into some of this thin structure from the earnings conundrum, bringing us closer to 45 as a target, then breaking down underneath the lows, which would be at 40.50, brings us back down through this thin structure towards the gravity point here, much closer to 37. So looking for Roblox to just violate this range in some form or fashion, and probably favoring a move if it agrees with the direction of the broad market and whether or not we're trying to find a higher low or making the equal lows at the bottom of the SPY balance, the QQQ balance. Next up is DOW, Dow Chemicals, right? If I have ever seen a textbook head and shoulders, this has got to be it. I mean, look at this thing just staring us right in the face, breaking down from the neckline here. And we've got ourselves a little bit of a 3-bar play. It's an inside bar there. Ideally, it's a little bit lower in that range, but the upper wick certainly representing a rejection on the back test of the neckline of this overall pattern. And if we look left through here, there's of course thin structure. Therefore, our target really wants to be closer to 52.75 on the breakdown here, looking for some kind of setup for decent risk reward in the downward direction. Seems like a reasonable trade to be watching for, especially with the way that this pattern is setting up. And then last but not least, it's going to be on ticker symbol SE. This is C Limited, and this truly is a 3-bar play coming on the heels of an earnings announcement. So big momentum in the upward direction, little inside bar on today's session. And bear in mind, this is all as the market has been falling apart. So great relative strength as the market came in on Tuesday. C Limited was breaking and ripping to the upside. So big momentum being supported by volume on the earnings announcement there, a little inside bar in the upper third of today's range, today forming inside of the upper third of Tuesday's range, looking for that follow through in the upward direction on a break there for some momentum continuation. An easy target here would be closer to the $90 even mark, prior resistance from this general zone, and it's roughly a doubling of that range. If you take a measured move from this candle, stack it off the low, brings us roughly around that vicinity. I'm not saying it has to happen over the course of one day, but watching for some upside follow through in C Limited. That's going to wrap up today's episode of the Midweek Market Update. If you enjoyed the video today, let me know in the comments section or by giving the video a thumbs up. Don't forget we will be live tomorrow morning at 8:30 and Friday at 8:15 to catch the live market reaction to what's going on with the jobs report. With that said, everybody, I wish you a green trading week.